let's do this one. With regard to the price of closed-end funds, which of the following statements are true? Which of the following statements are true? Cool. Let's look at the responses here. B is the correct answer choice. Yeah, we got that one all right. So closed-end funds can be sold at a discount or premium to their net asset value. And my question is for all of you, why is that? So why are these shares capable of being sold at a discount or premium to their net asset value? Why is that? Can anybody tell me in the questions pane? So if I own closed-end fund shares, why can it trade at a discount or a premium? Yeah, supply and demand. Absolutely. So it's supply and demand. And that brings me to this slide here. Investment companies. So I think this is chapter 4 in the SIE textbook. And it's one of those chapters that's really key because the SIE might ask you about these different types of investment companies, all their little nuances and bits and pieces. But the most important here, I think at a high level, is if you can fill in this chart right here, this little grid, means you'll have a good grasp as to how these things work, how the dynamic plays in terms of their share price. So I was thinking that maybe we can all go through this together here and just knock this one one by one. So we know that closed-end funds was the answer to the question, but where does it go in this grid? So the first question that we ask is, well, is it actively managed or not? Is it actively managed or not? Are closed-end funds actively managed? Are they actively managed? Well, yeah, closed-end funds are actively managed. And we just said that because of market demand, right? Market demand, because they change on exchanges, they fall into this lower portion here. Closed-end funds are exchange traded, and they're also actively managed. So closed-end funds, you'll have a portfolio manager. He'll come into work every day. He'll sign in. He'll probably pull up the Wall Street Journal. He'll look at all the different movements in the S&P, maybe the Dow Jones. Right? He or she will look at their portfolio. They'll trade actively in and out. They're actively running around and trading all of the things in their portfolio. What's something that's actively managed but redeemable directly with the fund itself? Directly with the fund itself. So there's technically two different terms, but one appears a little bit more often. It's more synonymous. We're going to focus on the one type of investment company. So yeah, Vinaya, great job. So for ones that are actively managed, excellent, Abina. Yeah, this is going to be a mutual fund, aka an open-end fund. These are the ones that don't have any secondary market. They're redeemable directly with the fund. They're also actively managed. Cool. What's something that's passively managed? Passively managed, it's just supervised, but it's redeemable directly with the fund. Redeemable directly with the fund. That's going to be the UIT. Great job, everybody. And finally, what's the exchange traded investment company that's just passively managed? This one is an ETF. And by the way, if you're a portfolio manager for an ETF, you've got a pretty sweet gig. You come into work, you're passively managing your portfolio there, you're tracking that index. Maybe you'll come to work, you'll log on, you'll read the news, you'll watch some sports, you'll go out for lunch, you'll meet with some clients, you'll come back, you'll go to the gym, right? You'll go to your computer at 5, you'll check how your portfolio is doing, you'll sign off and you'll go home. Pretty sweet gig. So if you want to manage a portfolio, consider managing an ETF. ETFs are exchange traded, right? Exchange traded funds. They typically track a benchmark or an index. So which of the two following products above could trade at a price above or below their net asset value? That's my question for all of you. So we know that the other one is a closed-end fund. What's the second one? What's the second one? Which of these products can trade at a price above or below their net asset value? What do we think this one is? The closed-end fund, we got that from the question. This one here is going to be, well, this one's ETF. Yeah, exactly. This one is an ETF because, exactly like we were saying, it's exchange traded. And if it's traded on an exchange, at that point, the price of that security or that index or that investment company is going to be dictated by the forces of market, supply, and demand. Cool. Here's a quick question for all of you. So we have this idea of net asset value. So we talked about it in this question here. We talked about that the shares can be sold at a discount or premium to their net asset value. Which one of these four here calculates the net asset value on a forward pricing basis? Forward pricing. Which one of these is priced based on forward pricing? Forward pricing. So this is a term that you may see on the SIE, forward pricing. And forward pricing means that it's going to be filled at the next calculated net asset value. And we're talking about, as everybody said, great job, mutual funds here. We're talking about mutual funds here. So if you are buying into a mutual fund, you're going to buy at the next calculated net asset value, the next calculated net asset value, plus a sales charge. But the net asset value is always going to be calculated end of day, 4 p.m. or whenever the market closes. So if any orders placed during the day, intraday, before 4 p.m. are all going to get executed at that next calculated price. So if I place an order at 10 in the morning, 1 p.m., 3:50 p.m., I'm going to get priced in at the next calculated net asset value. If I place an order past 4 p.m., I'm not going to get that calculated net asset value. I'm going to have to wait for the next day. So if I place an order at 5 p.m., and the mutual fund has already calculated its net asset value at 4 p.m., then I'm going to have to wait a whole entire day to get priced in at the next calculated value. Another question for everybody here is, what is the term that's used to describe the price that an investor pays when they buy shares in a mutual fund? So what do you pay when you're buying shares in a mutual fund? Yeah, the POP. And the public offering price, when you buy a mutual fund, you're paying the POP. You're always going to pay the net asset value, and they're always going to charge you a sales charge. They're always going to charge you a sales charge for that. So mutual funds, net asset value, think forward pricing, and they're going to price it at the net asset value, and they're going to tack on a sales charge there for a public offering price.